So in this Q&A, we've got a question from Kamil on the community forum. As part of a longer reply, he's asked, when is a good time to trade and why? Okay, so thanks for the submission. I really hope I got your name right there. I know how it feels for people to get your name wrong all the time. That's happened my whole life. Very good question, one of my favourite questions, and there's a lot to this because it's so important. But I'm going to give you a brief overview along with some practical advice as to the different times and why and how you should be thinking about it. So the reason this is such a good question is because in trading, time is everything. There's lots of different variables, but time is one very big variable which has a huge impact on the markets. And everything is of course relative to time. This is why it's possible for two people to enter the same market, do the complete opposite thing, and both make a profit at different times. And that's why it can become confusing for people sometimes when they're doing different things and there's different advice and people get a little bit confused and mixed up in it. But it depends heavily on your overall approach to the market. Now this might be a slightly unpopular answer in places here for some people, and make no apologies, it's just reality at the end of the day. But some people will, well, many people will want an arbitrary value. They always go, oh hey, you know, if you trade between 7.32 and 7.25, you'll always make a profit. The reality is that's never going to happen. That's complete cock and bull. It's bullshit. There's not a 1, 2, 3 system like there is with match betting and stuff like that. And I think that's why some match bettors find it a little bit harder when they come into trading afterwards, because they expect a 1, 2, 3 system. Now, the more you think about it, the more you realise that that's not actually possible like that to be the same, because in match betting you're basically exploiting a bookmaker's marketing budget. That is your edge. It's very clear, cut and dry. It's always going to be there. In trading it's very different, and so that's why it's just basically not the same. So if that's what you're expecting, don't waste your time. So moving back to the question, it's not necessarily easy trading, and that's because you need to understand, well, a trader's job is to understand the situation, spot the opportunity, and then exploit the opportunity, or edge if you want to call it that. And if not, then the job is to do nothing, which is a very big deal as well. As I always say many times over, it's not what you do, it's what you don't do as well. A lot of people feel as though they should be getting involved, and they shouldn't be getting involved at those points in time. And I'm talking particularly about people who trade too early, because if the market's not active, then there's no opportunity. So you're going to be, well, you're just going to drive yourself crazy mentally, stitch yourself up, and probably do your nuts. So the question, back to some practical value to kind of give you a little bit of context and two different ends of the spectrum. So, time. If you're employing sort of like a swing trading approach, you want to be looking for, well, no matter what you're doing, whether you're swing trading on one end or scalping on the other end, which are, you know, they are opposite styles of strategy, you want to have some method, strategy, execution, and understanding of what's going on. But you're also going to want different characteristics and limitations within the market. So if you are swing trading, then you want a market where there's more variance, more variables, the price is more likely to move, and you want to be coming to that market earlier because you want to have the opportunity for the price to develop as well. In fact, with swing trading, that's often a problem for newbies too, because they might have an idea and then they're just not willing to sit on it and have that anxiety of an open trade and the potential for it to go against them. But you need more variable market. The market has to express, I don't want to give away too much, but express characteristics that will allow it to move. So it's not going to be a hugely stable market, and then you need more time to do it. So you need to get there a little bit earlier and get yourself in a favourable position. On the other end of the spectrum, you don't need maximum movement, you need maximum turnover. So I'm talking about scalping. So when you're scalping, a scalper's job is to exploit the volume as it comes into the market on either side of the book, taking out a little tick here and there, maybe a couple of ticks at a time, and absorb that liquidity for a profit. Now, if you think about it logically, you can't do that half an hour before the start of a race when there's no activity in the exchange market. So that type of approach lends itself to trading a lot later. So I'm saying typically within the last 3 minutes, 2 minutes, last minute even. When there's maximum turnover in the market, there's maximum attention on the market, you've got the media sources looking at it, you've got all the punters piling in their money, all that kind of stuff. So on one end you've got scalping, the other end you've got swing trading. One favours movement, one favours stability and turnover, which is also a key there as well. In terms of market characteristics, is you want that stability and you want there to be more fill, as we call it, or traded and matched money coming into the market, which typically comes a lot later. So thinking back to the question, very logical. That is exactly why, when you start to understand the why, you behave differently. So if you're looking for a swing trade, you don't want to be waiting until the last 2 minutes. I mean, you can still catch a swing and markets do move, particularly in the right markets in the last 2 minutes. Or let's be a little bit more extreme. You don't want to be trying to catch a swing in the last minute. And if you are scalping and absorbing liquidity, you don't want to be sat there 20 minutes out, overexposing yourself to larger stakes, very little money going into the market, no fill. If the price moves, it's not coming back. You're not going to have that freedom of movement and the possibility to get out against more volume coming into the market. So it depends largely on your approach. There isn't an arbitrary answer in terms of always trade between this time period, but swing trading, longer before the start, more movement. Scalping, closer to the start, more turnover. Hopefully that's a useful Q&A there. If you've got your own question, anyone viewing, then please put it in the comments below or submit over on the community forum.